Hey everyone, it's Imran back again with another Trader Chats episode. Today it's called Big Picture Macro, and who else other than the founder of Real Vision himself, Raoul Pal, to talk Big Picture Macro with us. Welcome, Raoul. Thanks for coming on the show.
Great to see you, my friend. Good to be here.
No, it's really good. I've been looking forward to this conversation for a long time. So anyway, I'll give you a bit of background on, I first heard about Real Vision in 2020. So quite late to the party. And I was out of the market or doing my own thing, and I was blown away by the content that you guys were putting out, and just, putting out for everyday people who weren't in finance. And it massively aligned with what I was doing at the time, which was trying to set up an options education business and lift the lid on options trading, democratizing that knowledge, because everyone thinks it's all scary and for rocket scientists when it's really not. And I was just so happy to get the opportunity to appear on your platform, speak to Roger Hurst, who is a legend, and yourself. And just, I want to thank you for letting me do that. And, creating a course on your academy has been a lot of fun as well. So just, from the bottom of my heart, I want to thank you for that opportunity. And why don't you...
And I want to thank you also for what you're doing, right? It's really important. We've seen a massive rise in the use of options amongst retail investors, which is a good thing, but they need education. And what you're doing is fighting the good fight in the same way that Real Vision does, is to make sure they're given the tools to understand what they can do to take advantage of this stuff.
Yeah, and the thing is, there's a lot of people out there who maybe aren't teaching quite the sensible way to use options, and it's very much a gambling game, because a lot of the option use over the last couple of years has very much been that, right? Throw $1,000 into this, it might turn into 10. Yes, it might turn into 10, but there's about 5% chance of that happening. There's a 95% chance you're going to lose all your money, right? And that's what we're trying to explain and prevent people from doing. But anyway, that's enough about what we do at Options Insight. How about, I'm pretty sure everyone who's watching this already knows, but why don't you give us a quick...
Yeah, I'm going to skew it a little bit towards options and derivatives, because that is actually my background, right? Okay, macro good. Just ended up coming from that. But right. Really, I started my career at James Capel, which was like a very famous brokerage firm back in the early 90s. And I was on the stock index derivative desk. So I was doing stock index derivatives, futures and options. So I started in the options business in 1991, something like that. And what I realized is the biggest users of derivatives were the hedge funds. And I liked the way that they thought. So I then moved to NatWest, where I ran the international equity derivative desk. That's what I was hired for. But then soon after, 150 people from Morgan Stanley joined, and they kind of rebuilt. And there was a legend of the industry at the time called Rick Goldsmith, who was like the main hedge fund salesperson, probably the highest revenue generating derivative salesperson in the world. And Rick was running this whole business. He said to me, "Listen, Raoul, we're going to restructure this. What do you want to do?" And I said, "What I really want to do is build a hedge fund business." He said, "Fine, who do you want to know?" And I gave him a list. It was ridiculous. My list was Paul Tudor Jones, Lewis Bacon, Julian Robertson, all of the legends of the macro hedge fund world, and long-term capital, and all of these people. Said, "Fine, come to New York next week. I'll introduce you all." My first meeting was Paul Tudor Jones.
What's he like?
He's a lovely guy, actually. He's a really, really lovely guy. He was a mentor to me for a long time.
Oh, no.
So then I was headfirst into that. NatWest Markets was being sold off to Bankers Trust, and I decided to swerve, and a bunch of them moved to Deutsche, and I moved to Goldman, where I started and ran the hedge fund sales business in equities and equity derivatives, and then built a huge business there before eventually going across to the dark side and going to a hedge fund, to my biggest client, GLG, and started and ran the global macro hedge fund there, all the way through the kind of recession of 2000, 2001, 2002, through the other side, before eventually semi-retiring or opting out of the rat race, moving to the Mediterranean coast of Spain, and started writing macroeconomic research for this kind of hedge fund community that built. I've been in the business longer than most people had, and I was writing research that spoke the same language as them, looked at the world in the same way as them. And that was a word of mouth success. And over the years, that's still been going for 19 years. And with that, I have had many people with me for 19 years of the journey. Everybody from GLG to Goldman Sachs to many of the world's largest hedge fund family offices, sovereign wealth funds, and high net worth individuals. Part of that journey as well was the journey of 2008 and 2012. 2008 was obviously the big crisis. 2012 was massive in Europe. We almost lost the entire banking system and the government bond market. I had predicted both of those things and made a good amount of money trading. But also at that point, I saw people come up to me, friends of friends of my parents, saying, well, why didn't we know? I mean, people were wiped out. I had friends of mine go bankrupt, all sorts of stuff. And I thought, well, if I knew about it and they didn't, something's wrong here. And that was the same as the rise of Occupy Wall Street and that pushback against the system, that the system's rigged against you. And so I thought, what can I do about it? And I did two different things. One was start Real Vision to democratize the access to the kind of information that I got by bringing the world's most famous investors, analysts, strategists on to talk at length, which was never done before. Real Vision invented that whole long-form financial media thing. The other side of that equation was I discovered Bitcoin as an answer to a broken, over-leveraged financial system where nobody knows who owns what. I saw the asset. I wrote the first ever macroeconomic strategy paper on Bitcoin in 2013. It was trading at $200 when I bought it. And I did the kind of back of the fag packet maths and said, if this is valued in the same way gold is valued, just in the stock to flow, what's above ground, what's below, what's yet to be mined, it's worth $1 million. So, and it's trading at $200. And I said, I assume I'm an idiot by 90%. It's still worth $100,000, and it's only at $200. This is the best risk reward we will ever be given in our entire lives. And I've ridden that tiger by the tail as well.
Yeah, you have indeed. In fact, you were the one who got me into Bitcoin in 2020. I had a tiny scrap of it before that, but I only decided to put a more meaningful amount of money into it in summer 2020 on the back of some of your stuff that you were putting out there for everyone. Okay, but so you've been on the banking side like myself, you've been on the hedge fund side. But obviously through watching all of your content and how you talk about markets and how you'd like to, you're very big picture, right? That's why we've called this big picture macro. And, what is it that has kind of helped you cultivate that skill and that way of looking at markets? Because I don't think anyone zooms out as much as you do. I've got a technical analysis friend who looks at 100-year charts, but he's like the only one. Outside of that, you zoom out the most. So why is that, and what gives you that edge?
So look, the markets are a competition, and you need to find your edge. Your edge may be options. Now, I've traded a lot of options in my life, but what I found, I was at GLG, and what was happening was the hedge fund industry was changing. So the investors used to be family offices, and they didn't mind a 30% volatility macro fund, or 15, 20% volatility macro fund, because those guys would occasionally have 50%, 100% years. Then the pension money came in and the insurance money came in. And those guys said, we don't want that volatility, but we want the alpha. So what we're going to do is force you to lower your volatility. So you get monthly returns of 1%, let's say. So what happened is it changed the entire industry. So as opposed to taking big picture macro Soros style bets or Stan Druckenmiller style bets, you have to manage your P&L on a monthly basis. Because if you, heaven forbid, you had a down 5% month, all your investors were screaming at you. So what it meant is you couldn't trade the long-term time horizon. You were basically trading a 1 month P&L. And it didn't matter if you bought something at 100 and it went up to 120 in a month. If it fell 5% the following month, you'd be forced out, which was crazy because you didn't look at your entry price anymore because it didn't matter to these people. So I just said, I know where this is going and this is not good. It's the death of returns. And the only people who are going to get paid are the people who own the hedge fund businesses because they will have massive assets. So we saw people like Alan Howard go that route, which was a massive asset gatherer. He changed somewhat later, but we saw the rise of Millennium, the rise of many of these, and it changed the whole industry. So when I started writing GMI, my premise was all of the edge is in the longer term time horizon. Now, with that, you have to take more volatility. That's a function of time horizon. Now, you can take as much risk as you want within that. I've even changed my views on that over time as well. So you just reduce risk, extend time horizon. And I proved it with GMI. I mean, my track record of that research service, and because I publish all the trades, I don't calculate a full P&L, but generally speaking, I've had multiple up to 100% years. I've had one terrible year, 2009, which was down 50 or so. I've had multiple 100% years. I mean, it's crazy just because I zoomed out. And what I found is zooming out makes you not become, and you hear me talking about this a lot, a mid-curve person, where you're arguing about all of the details. It's like, does this thesis hold up over an extended period of time? And can you simplify it down to the most simple things? So I started GMI with a simple framework, was debt, deflation, demographics, or a ticket to bankruptcy. That was my entire thesis. And I've ridden that entire thesis up until 2020, when I started looking at the exponential age and monetary debasement, because I didn't really understand. Most macro people didn't understand the world after 2008. And I realized we were just looking at it wrong. So that changed my thesis. But still, the long-term time horizon has given me the best returns. So, if I go back to the Bitcoin example, because that's the most extreme, is I bought it at 200. It went up 5x in 3 months after I bought it. I'm like, holy shit, I'm George Soros. I'm the best trader ever. It then fell 87%. But I had a 5-year time horizon plus when I first bought it. In fact, longer. Then it got very complicated in the space in 2017. They were forking different chains and all this stuff. And I'm like, I want out. But I made 10 times my money. Sold that at 2000. Now, that was because I held all the way through the volatility. That I got compensated for that by the returns. Now, you don't always do so, but that's what you're trying to do. And I sold out, which I should never have done, obviously. I went back and looked.
That's selling out. Was that due to not understanding because like you say, you zoom out and you want to have as simple an argument to explain your thesis. And when you've got this new technology and all this forking going on and you can't simplify it anymore, is that the reason why
That's right. So now I'm like, I don't understand the risk because what change is going to get adopted? I wasn't deep enough into the space. So that's the right thing to do from a macro perspective, is when you lose the clarity of your initial big picture view and that starts getting tested in a way you don't understand. So it was the right thing to do, but looking back, it was the wrong thing to do because my original thesis was 100% right. And I should have just kept on with that.
Then what drove the decision to get back in then?
So I was always interested in it. It's not like I lost interest. So I followed the space. We educated people on real vision. But, after 2018, it was a big bear market. 2019, I started really focusing on it again. It had rallied off the low. It then tested and it built a beautiful chart pattern, this lovely giant triangle. And it reminded me of the silver chart back in 2003, where we built this big triangle. And what it does, it tends to hit the top of the triangle. Everyone gets ready for the breakout. Then it drops back into the middle of the range, wipes out all the short-term longs, and then explodes. That is exactly what happened in March 2020 and April. And I just went, I know this. I know how it works. So I started getting, beating the drum about this, started getting very long. And then eventually my whole understanding of the kind of risks I wanted to take changed, because I realized that this was a supermassive black hole. It was the best performing asset the world had ever seen. And due to its unique properties of Metcalfe's law and adoption models, it was likely to remain so. So I just started looking at everything versus the chart of Bitcoin and realized that everything was an inferior asset and anything would be a suboptimal asset allocation. Now, normally you would say you want to build a diversified portfolio and you need to be more careful. And I'm like, I've got an income stream. I've got a savings pool. Your savings pool was never as much as you want it to be. Here's the once in a lifetime opportunity. So eventually I just stopped investing in almost anything else. And that was this irresponsibly long phase, which is like, well, this is my one bet. This is the true bet. Because I thought the macro had gone down to the simplest possible thing, which is monetary printing was debasing the currency. That optically makes assets rise. When I rebased all assets by the Fed balance sheet, because that's what I was using at the time, I've got more complex since then. The only two assets that outperformed the balance sheet, i.e. were actually going up, were crypto and tech, but crypto was going up 10x the speed of tech. So I'm like, okay, this is the one bet. This is the biggest bet. It's the same thesis I had in 2012, 13, but now was the real time to get involved. And, yes, I still have some tech investments, other stuff. I occasionally trade around bonds and other bits and pieces just for the vanity, not for the performance, because really it all comes from this. So it's really changed. So I'm now ultra big picture, ultra concentrated. I don't use leverage.
And you've called, sticking on the Bitcoin topic, because you've called it the life raft before, right? You had a very popular video, I think, on YouTube explaining that thesis. And is that still valid to you? That
very much so.
strategy?
I mean, very much so. So my thesis, I did two. One was the retirement crisis, which is, I don't know, had millions of views online. And the other one's Bitcoin life raft, which also had millions of views. And my hypothesis was, if you're in your 30s or early 30s, you have an inability to buy property. You have an inability, I mean, the amount of equities you can buy versus your parents, i.e. from your disposable income, is minuscule, and bond yields were virtually zero. So how the hell are you going to generate wealth? So I also understood that the financial markets are broken. There's excess leverage, and they're going to have to change the system, which was my original hypothesis in 2013. And that blockchain technology was a great way of rebuilding financial markets from scratch. And that these were going to be, not parallel paths, convergent paths. So I thought institutions also were not able to invest yet. So you get the first time ever a chance to front run them, because they're coming, but they're not in yet. So I thought, well, if you are young, this is going to be the biggest opportunity you've got, and it's going to suck in millions of people. And it has. I mean, Coinbase, monthly active users is 9 million people, which is far larger than Interactive Brokers, Schwab, Fidelity, because people can buy a fractionalized part of a Bitcoin. They can't do that with a Berkshire Hathaway. It also has higher returns, so to make up for the lost time that everybody's had, and the inability to gain other assets. So it's been extraordinary. I mean, MBER wrote a paper I read yesterday about the what's happened with crypto wealth in America, and how these kind of younger people, it's been the thing that's allowed them to buy houses. It's also got them into the stock market because they've diversified, because it is a very volatile, tough asset to be involved in. And then so people diversify afterwards. But so that Bitcoin life raft is not only saving the future financial system, they're saving your future purchasing power from the debasement, and it's giving you an opportunity to actually generate real wealth on a scale that people's parents were able to.
But the wealth generation is a function of obviously the price going up, right? But the life raft thesis was also based on the idea of freedom of your money, right? As in, if CBDCs are coming, and where are we on that path to CBDCs in your opinion?
So again, when you zoom out, the issue is the governments don't collect enough taxes to pay for the interest on the debt. So that's why they're printing money. So my thesis was taxes are going to go up. And the only way they can do that is capture as much capital as possible within the taxation system, which is fine. I mean, that's why you choose to live in a country you choose to live in and whatever. But then the introduction, so I've been following the story of behavioral economics and how powerful it is. I mean, that's why we all follow slavishly likes on Twitter and retweets and all of that stuff, right? It's all behavioral economics. Daniel Kahneman taught all of those guys from Silicon Valley how to turn us into dopamine rats. Now, what I realized with CBDCs, it does the same, but with money at scale. And so what governments were able to do was some really good things. Like we saw the stimulus in the pandemic. a billionaire got the same payment as somebody who's on the breadline. That was crazy. But there was no way of segregating people. So once you can do it on a central bank digital currency, you can give different stimulus to different people. You can give regional stimulus. You can give stimulus. You can do all sorts of things. You can penalize excess savers and incentivize people who don't have any savings. You could give poor people 10% interest rates and super rich people 1% interest rates. There's a lot you can do that is actually very powerful in running economies. The dark side of that is it'll get used for bad. And it'll get used in ways where they can stop you doing certain things with your money. And that becomes a lack of freedom.
Canadian truckers, right?
That's right. I mean, so it comes with a lot of really good things and a lot of really bad things. And governments over time will always err towards the bad things too. Now, the balance is, who do you vote in? Who do you agree with? But it's usually like a frog in a boiling water. People don't realize until it's too late. And I realized that having freedom over your money, particularly, and this went back to my 2012-13 thesis on Bitcoin, is a bearer asset in an over-leveraged world is incredibly valuable. Because you've seen it, FTX and all this stuff where they're using your asset as leverage. When something goes wrong, there's not enough collateral for all of the debt. So poof, your money's gone. That was the European banking story as well, and the 2008 crisis. Now, if you own Bitcoin, store it in your ledger, you're out of that system. So yes, you have to stomach the volatility of Bitcoin, but the good side is nobody can take it away from you. And that is unbelievably powerful. And it's really interesting to see Larry Fink starting to talk about this. A system of international money is something we have needed that is free of government interference. Now, somebody like America will say, well, those people bad, us good. Everybody's equally bad. They'll find ways. The Chinese have a social scoring system. The US also has a surveillance state. I mean, I go into the US, I'm scanned immediately for global entry. They know where I am. Everywhere you use your Apple Pay or whatever, everybody knows where you are. Google Maps tracks you. I mean, you are tracked in every inch of your life. Now, you can still track Bitcoin, but at least it's in your control. Somebody can't say, well, that's mine now.
They can't.
That's incredibly powerful in this world. And obviously, its functionality within a digital world where our lives are becoming increasingly digital makes total sense.
Yeah, I mean, they can't confiscate it, but they can make it hard for you to use it, right? I guess that would be the way that they would try to ban it. Obviously, how many countries have already tried to ban it doesn't make any difference. But as long as people are willing to accept it, it's going to become the alternative of cash in your hand, basically, right? It's going to be, if cash goes away because of CBDCs, this is effectively your only version of cash.
I mean, look, the truth is none of us use cash. It's a bullshit narrative. Oh my God, we all use credit cards, right? So, or Apple Pay, or whatever it is, right? Venmo. So people making this argument, that ship sailed a long time ago. The privacy ship sailed when Google started and Facebook started. That's all gone. But the point is, the only other answer to an international system of money was gold. And you can't cross borders. So you have to store it expensively in Switzerland and Singapore and the Cayman Islands. And so you can give yourself some protection against overreach by government, whatever that may be, or war, or any of these bad outcomes. And Bitcoin changed that entire equation because you don't need anything. If you can remember your seed phrase, which is not easy to do, but essentially it's mobile. It's a mobile system of security that allows you a certain sense of personal freedom. Because if you are not happy with the UK, you can leave. Now, you have to pay your taxes, not about tax avoidance. It's about personal freedom and security over your own money.
Yeah, I mean, I was amazed. I was literally amazed when the regional banking crisis kicked off in March, the price action on Bitcoin and the way it was behaving, and it completely decorrelated from stocks. I mean, that really impressed me.
Well,
right?
I learned that lesson the first time in Cyprus. When Cyprus defaulted on its banking system, Bitcoin exploded. And I'm like, because look, in what we saw in the regional banking crisis is how digital money is now super fast. So you can withdraw money from your bank in seconds. You don't need to queue up.
Mm-hmm.
So the way you can transfer it into Bitcoin instantaneously is incredibly empowering as well. You feel in control of your money. You don't have to line up at the bank and ask for your money back in cash and then stick it. I mean, don't forget 2008, how many of our friends went and bought gold and put it in their garden? I got cash out in 2012. I had some Bitcoin 2013, but the European crisis, I got like 50 grand in cash because I was worried the banks were going to close.
Mattress. You put it under your mattress.
Yeah, and that's a stupid way to live.
Yes, interesting. Well, I don't want to keep this whole thing about Bitcoin. I wanted to ask you about some other big picture things that you've been talking about over the last year or so. So the next one to talk about is the exponential age stuff. So obviously you brought Kathy Wood on to Real Vision, a lot of in-depth conversations with her. And it seemed like she was what you needed to kind of convince you about this technology story really having some legs. So my question is that the latest innovations in AI, is that the catalyst that a lot of these innovation companies were waiting for to help them achieve their potential?
So,
and go on, I'll let you answer that one first. Go on.
Yeah, so first, Kathy was kind of at the peripheral for me. I'm a macro guy, right? And tech always looked overvalued. And so I didn't really like it. I understand there was a lot of technology coming and it was an interesting space, intellectually interesting. But as a macro guy, I just didn't understand it. And it was not until I sat down, I saw the debasement of currency and then figured out that the NASDAQ outperforms it all, that I'm like, what do I not understand here? And then I started seeing the big picture, which was what I refer to as the exponential age, this nexus of all these technologies coming together and completely disrupting everything that we know. And that my expectation was back in 2020 that we were going to see the largest pace of technological change the world has ever seen in the shortest period of time. Because many of these technologies had been worked on, but we're now getting ready for public release. And blockchain was one of them. So that was the fastest adoption of any technology the world had ever seen. But my thesis was built around AI, robotics, data, compute, Internet of Things, genetics, genetic science, EV, all of these things, this big picture space. And I realized, oh my God, this is all going to happen at the same time. And how the hell are we going to cope? It's like a fourth turning moment where we completely reimagine everything. And I started writing about that in 2020, and everyone thought I was a total moron. That I was just like a Kathy Wood junkie, and I was, I couldn't see it. I was an idiot. And I didn't buy any until 2022, when I started averaging in from about May into the big sell-off. Because I'm like, here's the opportunity. I usually step back, use a big log chart, put the standard deviation bands on it that I can do easily on my Bloomberg. When it got to about 2 or 3 standard deviations oversold, that's usually like a once in a lifetime opportunity to buy a secular trend. So I started buying a basket of stuff. And then again, people thought I was stupid until got to about November 2022 and AI came. And everyone was like, oh my God. And then by February, OpenAI had gone from 0 to 100 million users in 5 weeks. And the world has changed completely. And that was just the start. I mean, the robots are coming out, self-driving cars. I think it's a year and a half away now before Tesla cracks that entirely. We're seeing that at a number of different levels. We will see a lot of this stuff accelerating because AI is an accelerant. It's like a foundational layer, compute power, NVIDIA, all of that kind of stuff. The semis plus the AI level layer, and then the energy layer, which is the cheaper cost of electricity driven by EV, green energy, and nuclear will lower the cost of energy, and that's going to create a productivity miracle over time.
Okay, so on the energy question, don't we need a ton of fossil fuels to get us to that energy future, though?
Because this is always the pushback.
Right?
The pushback is yes, but the answer is you have to take that pain to get the upside. If Europe, who's the most advanced, this UK is pretty good, but Europe as a whole, if they solve this, they're already generating more power in Europe generally from renewables than fossil fuels. I think the UK is probably the same as well. If they continue with that trend, they are forcing investment into the space. Several trillion has gone into that space. That creates technological advance, which lowers the cost. People will push out. These carbon credits are doing the same. They're forcing people to invest in cheaper energy, more technology. It's cheaper, cheaper, cheaper. Now, whether, we've seen Finland make a move on this. The new types of nuclear will come into that equation. The outside, if they solve this, if you think of the world now, we've got aging population, highly in debt, low growth. And productivity has been going down and down and down. So you're going to have to take some pain, and it's going to end up on the central bank balance sheet to do it, which is to subsidize this, the fossil fuel transition, until you do that. The faster you do that, if you look at the inflation adjusted price of oil since about 1960, it's about $40. So that's your fixed cost to all productivity. And technology just means more output per barrel of oil, call it that. So it translates into electricity. If you can drive down that barrel of oil equivalent to $10, the multiplier is 4x. That's fucking staggering. That will change everything for humanity. If you can get the marginal cost of electricity down to near zero, you will change the outcome for society. So I think it's exactly what Europe should be doing. And yes, they will take some pain to do it, and they should do it. The US kind of did this in the 1940s and 50s with the New Deal. They rebuilt the infrastructure from scratch. And what happened was the 1960s, where we started to see a boom, and that really drove America up until 2000 probably.
Okay, and on the exponential age thesis, so what about the high interest rates, right? Because I can see why the mega cap tech stocks don't care about rates being high, but these companies who might start to make money in 10 years or whatever, and have got a great idea, but have got no earnings, they got trashed in 2022 for that reason, right? That the rate cycle had turned. So is part of the thesis built on the idea that rates have to come back down, or can these names actually grow into their potential in a higher rate environment for longer?
Yeah, so basically all of these kind of growthy tech companies are doing, 100%, 50% a year, 100% a year growth. So, 5% interest rate in the end doesn't make a difference. What the value of the equity is lower, but the growth rate will mean that we'll still get investment. So I don't concern myself with that. The big thesis is I don't believe with an aging population and high debt that you can have sustainably high interest rates. And I've proven in the everything code, that the entire increase of the central bank balance sheet of the US, the UK, and Europe and Japan is just the monetization of interest payments. So what they're doing is just debasing the currency to pay the interest because the interest payments are too high. And that tells you, well, we're either going to get massive central bank printing with rates at 5%, or they're going to have to get rates back down again fast. And that's what I think the game is. I think with trend rate of GDP at 1.75% in the US, you need to get interest rates down to the same kind of level because the government is 100% of GDP in debt. So if interest rates are 1.75% and growth is 1.75%, then all of GDP growth just goes to pay the government debt. Mm-hmm. That is not sustainable considering the private sector is another 120% of debt. So this is the game in town. That's what the everything code is built on.
So the way I understand the everything code in layman's terms is that there's so much debt out there, government debt out there, and it's on a refinancing cycle of 3 or 4 years, right? So that's the cycle we're in, basically, where they've been able to raise rates. And by the way, on the rates issue, they didn't raise rates for how long, right? But it became political because you saw goods inflation, you saw energy prices. The everyman was getting killed from his grocery bills, that it became political, right? That the Fed was basically almost coerced into raising rates. But like you say, if rates now stay up here, they're going to have to refinance at these high rates, which is going to kill them, right? So
if you have this framework of understanding that they have to get rates down to GDP growth or below, so that tells you the world doesn't function with rates above 2%, let's say 1.5%. So to absolutely ensure they need to do it, they need to stamp out all inflation expectations now, so then they can cut it down to 1.5%. That's what is going on, because they know they have to refi at 1.5% or less. If not, the balance sheet goes exponential.
When is the refi due then?
It starts at the back end of this year, and it's really in 2024 and 2025. And
so
then
if they haven't managed to get rates down by then, they've got a big problem.
Huge problems, because you either completely collapse the economy because the government interest payments take out all of economic growth and shrink, plus the private sector, or the balance sheet needs to go exponential, which would be horrific, because then asset prices go, you lose control of the system if you're not careful. So this is, I think, the game. This is why Jay Powell is being so obstinate about rates, even though everybody and their dog with a basic understanding of forward-looking economic indicators can tell that, we've killed growth and killed inflation. He just has to get that inflation expectation down so they can cut rates to 1.5%. If he can engineer headline inflation to go negative, which I think is going to happen, he's got the green light to cut back down to 1.5%. Right? It's just once you understand this, and look, Yellen ran the Fed. There is no difference between the BOJ governor and the Ministry of Finance. There is no difference between the Treasury and the Fed. There is no difference between the ECB and the governments. They all are in this together because nothing works unless they do, and they all understand the game they're playing.
Yeah. And which is why, so the everything code, I guess, is called that, because what you're saying is everything's the same trade, right? Like, we're in a state of the world where there is no option on a long time horizon than for them to get rates back down again and monetize the interest payments, right? And because of that, the debasement of currency, fiat currency, has to continue. If that is going to continue, then all asset prices are going to go higher in nominal terms. And guess what? If it's all the same trade, you probably want the one with the highest beta to that.
This is exactly, that is why I'm super concentrated.
Yeah.
The everything code is also very interesting. Why it's called the everything code is I backed it out a number of different ways, and it all came up to the same answers. Is, okay, we can forecast debasement based on either trend, or we can base it on the interest payments, or we can base it on demographics. They all come to the same thing. And if I can therefore forward forecast liquidity, and liquidity, which is debasement, a lot of people are misusing liquidity in how I think of it. Debasement is how I look. If I can forecast it out to 2026, and the NASDAQ has a 97% correlation, I can forecast assets out to 2026. Now, this is a thesis, a hypothesis, which is why I don't release any of these targets publicly. But what it suggests is it's all one trade. So then, as I said, you just want to buy the biggest performing assets. So I've been saying this beginning of the year, all of last year, this is what's going to happen. And if I look through the asset growth now, so obviously Bitcoin is up 83%. The next biggest is my Exponential Age basket, 71%. Then the NASDAQ, 42%. Then the S&P at 17%. So it's showing itself exactly as I expected. And that's without much monetary stimulus. Basically, monetary stimulus has gone sideways, but year-on-year rate of change is going up.
Yeah, it's interesting because, obviously you do your macro insiders with Julian Brigden, right? And you guys do a bit of sparring every month there. But Julian's still pretty adamant, correct me if I'm wrong, that tech stocks are overvalued, right? So like, what are his main points that counter yours?
So mine is really a completely different understanding of macro. And that's what people struggle with. Because basically I walked away from everything I knew based on this new truth. I even figured out, I knew there was something wrong with people saying, well, P ratios keep going up, they're the highest ever. And I'm like, no, I'm sure of it.
matter.
It took me ages to prove it, that the P ratio is actually based around debasement, because the P goes up in debasement, but the E doesn't. So the P ratio keeps rising. So, one is a function of economic growth, the other is a function of debasement of currency. So I'm like, you're using the wrong metrics. So everybody's using the wrong metrics. And I think Julian is still using other metrics. Now he's got a shorter term time horizon than me. So he can still trade around, make money doing different things. But I think the macro has entirely changed. That's what I've been trying to educate people on, is the macro we all grew up with doesn't exist. It's now into another phase. And I think we had the Great Reset in 2008, while many people still expect a Great Reset. If I think of a Great Reset in 2008, they basically said nobody has to pay interest. And the government's never going to pay interest again, because we're just going to debase the balance sheet. Okay, that is a reset. It's basically a debt jubilee without cancelling the debt.
But we are in a period right now where there's a pause in that, though, right? People's mortgage payments are going up to 6-7%. They're clearly paying interest, right? But I guess what you're saying is that is just a cyclical upturn in rates that is not sustainable.
Correct. Right? And this rate cycle was driven by two things: the pandemic reopening, not enough supply around, so supply chains, and the extra demand of people coming in, much like straight after World War II, we saw very similar. And some of the direct stimulus payments, because that obviously goes straight into direct spending, but that usually comes back out over a year. That is mainly the driver of this inflation. And all of that is coming out. Now, Russia was the accelerant that took inflation higher than it, the Ukraine crisis higher than it would have been. So maybe it would have peaked out at 6%, which would have been still a high, tough cycle, but we got the extra 3% because of what happened. I think all of that gets unwound. If we look at the Truflation forecast, it's already at current inflation is currently like 2.1% in the US. My work suggests that we probably hit zero or go negative within the next few months. So that's a complete unwind of the inflation spike. Now, the dirty truth is, as we all know, prices never come down.
No,
commodity prices can, but for you and I, prices never come down. And that's just made people that bit poorer again, because wages never went up as much. Now, people argue that wage growth is going to continue to rise, but not in an inflationary environment and not with AI. It's just not going to happen. So there is this pulse of wage increases to stop people getting ridiculously poorer. They're much poorer in real terms already, but you can't keep driving it higher because it's just not going to work.
Yeah, and I like the everything code idea. I mean, it kind of explains why you said crypto has become macro, right? Because if everything's the same trade, then that is, crypto is just as macro as anything else, right? And I think the real kicker with crypto is what you said earlier, which was the instos still aren't in yet. I was going to ask you, like BlackRock ETF coming in, the likes of Fidelity and Schwab and everyone getting interested, EDX markets. It seems like they're gearing up for it, right? They're gearing up for this massive wave of institutional adoption. And that was what we started to see in 2020. I mean, that coupled with the halving next year, I mean, you got to be, I'm guessing, are you about as bullish on Bitcoin as you have been in a while?
I own very little Bitcoin. I'm actually more bullish on ETH, but it's the same thing, right? We're talking about capital going into the space. Yeah, you've got the perfect setup. We had a massive bear market. It hit that long-term trend, 2 standard deviations oversold, triggered all the kind of technical signals you want. Right when my forward-looking indicators suggest the economy starts picking up over time, but debasement is going to increase. It's like it's the perfect signal. And now you've got the institutions to come into the space and regulatory clarity in the UK, Europe, Switzerland, Australia, Hong Kong, Singapore, and the US will get it at some point in this cycle. And then the Bitcoin ETF. It's like, okay, this is it. Game on.
Yeah, I mean, I think owning longer dated call options in this stuff, vol's very low relative to where it has been.
So
right?
here's what I want to give you a bit of your thought process on this. So ETH is really interesting. And the reason being is because the more activity, the more ETH gets burnt. So supply keeps going down. They've now got staking, so that's removing stuff out of the market. So in a bull market, there's going to be less and less ETH. Most people are going to stake it in some way, shape, or form. So the liquidity of ETH on the upside is going to evaporate. My guess is the skew in ETH call options out a year or so doesn't take this into account. Because
I've been monitoring
volatility on the upside will go ridiculous. Maybe we say 200% vols in ETH at some point, if I'm right.
Yeah, I mean, it's certainly the thing about the skew in crypto is it's so volatile, right? And it's so spot sensitive. So like you get a week of weakness and suddenly the skew's all for puts again. You get a bit of strength, it flips. Now the long end's a bit more stable and more flow driven. So you've had a lot of flow in upside on Bitcoin, buying upside for that because of the halving story, the kind of flight to safety on the regional banking. There's been a lot of reasons. The digital gold story has been quite strong this year, right? Whereas ETH's been like, is it a security? Is it not? We don't know. That's been the difference between them. But yeah, if we do go into a full scale crypto bull market again, I don't disagree with you that ETH upside.
People are sophisticated. There's great ways of funding ETH calls with selling Bitcoin calls. So you're trading the vol spread and the price spread. You can do it delta neutral or not. I mean, there's a lot. I just have a feeling that the market is not pricing this correctly. I was speaking to some of the big kind of crypto traders at places, some of the big hedge funds, explaining this thesis. They're like, yeah, this is probably not priced because normally it has been for a while, relatively flat going out for a year. People don't know how to price long-term vols. So anyway, it's an interesting thing there.
We keep gravitating back towards crypto. We can't help ourselves. But anyway, before we wrap up, another thing that you and I have in common, and you're definitely years ahead of me on this one, is the path to going from finance into entrepreneurship. So I'd quite like to hear, what has been your experience of that, and in terms of, you're in markets for decades, right? And what are the lessons you've learned? Has your finance career and your trading career helped you as an entrepreneur? And what have you learned through that process?
The only way it's helped me as an entrepreneur is our ability to process information is vast and fast, right? That's what markets teach you. But being an entrepreneur is ludicrously difficult. It is so hard. And unlike markets where you can kind of just close your book, if you can't get it right, you can't see it right, you can't do it. You have to keep going through the good times and the bad. And and then managing people becomes hard as well. And it's hard. Being an entrepreneur is a really amazing thing. It's empowering, it's intellectually stimulating, but it's basically like running an over-levered book all the time. It's fucking terrifying as well. So it is not easy. And they all tell you, every story of an entrepreneur is, well, we started in a garage, we were short of cash, we ate pizzas for a year, and then we were billionaires, right? That is not how it works. And if anybody is really wanting to go down the entrepreneur's journey, and you should read this book too, you should read The Hard Thing About Hard Things by Ben Horowitz from Andreessen Horowitz. It's the only book that actually says what it's like, how difficult it really is, and the kinds of decision-making you have to do. I think one of the things that markets brings you, particularly if you're a derivative person, is an understanding of risk reward and bets, even within a business, how you can take bets within a business, because a lot of people don't see a lot of that. A business is basically a portfolio or a concentrated bet, depending how you structure it. And then thinking about that is actually very helpful. And I think a lot of people fail because of that, is not understanding risk in that way or how to mitigate it.
Yeah, I mean, the thing that surprised me is I've been doing it for 5 years, right? So not as long as you, but the number of ups and downs that I've had in a 5-year period is ridiculous. Just when you think it's working, you finally cracked it. 6 months later, you're like on the brink of like, oh my God, it's going to fail. and I say to any of my friends who ask me about starting a business, I say that if you don't genuinely love what you do, if you wouldn't do it for free, because you love it so much, don't even start, because the ups and downs are going to kill you. The first 5 years, you're gonna be so close to failing so many times that if you don't love it, you're just going to quit.
Yeah, it's exactly that. So read The Hard Thing About Hard Things. It helps you in that journey to understand, A, you're not alone, because being an entrepreneur is actually a very lonely pursuit, because you're always living with your own narrative. Am I a failure? Is this all going to go wrong? What have I?
Was this the biggest mistake I ever made? Right?
Am I missing something? You know, the things that wake you up at 2 o'clock in the morning. That's normal, and you have to learn to tame that beast, which is hard.
Yeah, and I think the thing that helps is community, though, in all parts of life. But I think if you've got a team of people and you're trying to build something together, that I think that helps keep you a bit sane as well, right?
Very much so. Also, dropping the European and particularly all of Europe mentality of failure, because it stops you taking risk. You know, the US, I found, you know, when I moved to Cayman, it was much easier to be an entrepreneur because you're surrounded by people who are more entrepreneurial. The UK is just not structured like that in the same way. You're not allowed to believe in yourself. And if you do, it's deemed to be a bad thing. While in the US, you can at least try.
I don't know. It's not that easy to try. The way they've been going after some of the crypto companies, it's not that easy to try in the US either.
I mean, that's true. I mean, yeah, I mean, the US is structurally changing, you know, and they're going to go after the AI companies, and these are the big breakthrough industries, and the US is trying to stamp it out. So, yeah, it's interesting.
All right. Well, it's been a pleasure talking to you, sir. Really, really appreciate you coming on the show. Hopefully, you know, your words of wisdom have resonated with the viewers.
Well, it's been a great conversation. I think we've covered a bit of different ground in this one as well. So hopefully there's something in it for people.
Yeah, exactly. We tried to. I mean, I've seen many of your interviews out there, so I wanted to try and make it a little bit different. But
yeah, fabulous.
It's been a
always
pleasure.
good to catch up.
Take care. Thanks a lot for coming on. See ya.